A survey of local economists published over the weekend showed that 20 out of 21 of them believe the Reserve Bank will cut rates again next month. And after today's producer price index, it'll probably now be unanimous. Wholesale prices rose to just 0.3% in the December quarter. And within that, the consumer segment saw prices actually fall. The CPI comes out on Wednesday and it's likely to be smack in the middle of the RBA's 2 to 3% target range. Nevertheless, the currency is rallying, making 104.9 this afternoon and 81.3 euro cents. Global investment funds are definitely inclined to take on risk at the moment, even though things look precarious in Europe, because they can get euros at 1% interest and invest the money here at 4% or more with very little currency risk. That's why the Aussie-Euro exchange rate has broken out so decisively over the past 2 months, from the 72 to 75 cent trading range that's prevailed for a year. It's called a carry trade. Borrow in one currency at a low interest rate and invest in another at a higher rate, and sit back and quietly collect a lazy margin. And of course, the falling euro versus the Australian dollar is the reason the gap between German and Australian cars has narrowed so much. This chart shows that it used to take 30 more weeks at average weekly earnings to buy a BMW 320i versus a Ford Falcon XT. Now it's down to 10 weeks more. Parity on this measure will not be good for the Australian car industry. Share market finished down 0.4% today, and the falls were modest but widespread. Qantas and Toll were among the biggest gains. And that came after a small decline in Europe on Friday, while in Asia today, markets were either steady or closed for the Chinese New Year. And that's finance.